Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast.
Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
All right, welcome back to Wealth on the Move, the podcast. I'm Will Hoffman, your host, and we're rushing back into this. We've been off for a couple of weeks as we go through a little bit of a business transition and, more importantly, an office transition. And the new studio is being constructed and worked on as we speak. But given the volatility that we've been experiencing over the last few weeks, we wanted to make sure that we got to you and got a good friend of mine, Ryan Detrick, Chief Market Strategist from Carson Group, is joining us today. Ryan, how's it going, buddy?
I don't know. Do you want the honest answer?
A little bit of a wild couple of days, huh?
Yeah, a couple of days. I mean, we're going to get into it. I know we've got like ballpark half hour, but I'll just say this. I'm excited to get to break bread with you once again, like the old days. A lot to talk about, but it's an honor to get to come on with you and talk a little bit about how we see the world. And boy, oh boy, I mean,
well, and
I know we're recording this. When do people hear this? Like, because the world changes so fast.
Well,
how quickly do you think it will happen?
It's Monday, April 7th, and okay. I'm going to ask you quickly because you and I are both born in 1978. We've both been in this profession for about the same amount of time. This is April 7th, 2025, and this is a great day to timestamp this. Have you ever seen a more wild trading day than April 7th, 2025 when it comes to market movements?
Well, yeah, just people know we futures, by the way, open on Sunday night, down 5 or 6% on the S&P. Then we were up about 3% or so this morning on rumors of a 90-day kind of pause. And now we're down a little bit. Looks like we're going to close a little bit down by the time the day is over. We'll see. But, I guess March of 2020, we saw some days like this. But Will, it's really rare. I mean, let's put this in context, right? Thursday and Friday, S&P lost 10% those 2 days, one of the worst 2-day sell-offs we've ever seen. But each of those days lost 4%. Now, we came in to Monday thinking, oh, my goodness, we'd be down 4% again. I'm not going to have it, but if we would have had 3 days in a row down at least 4%, it lasted only time that's ever happened was the Great Depression. All right. So we're again, I want to be clear, we're avoiding that, but with one big down day on Monday, like we thought we were going to have, we're talking, this is pretty historic. By the time people listen to this, maybe we're in a bear market down 20%. We're flirting with it, but it's been a heck of a run. And this day is one for the ages for sure.
Yeah. Well, and again, we have a lot of commonalities, that being that we're both huge fans of NFL teams in the AFC North. So we both agree that we can pin this one on the Philadelphia Eagles, because every time the Philadelphia Eagles, or really a team from Philadelphia for that matter, win anything, bad things happen. You had a tremendous post on X a few days ago about when Philly wins, bad things happen. 2018, they won a Super Bowl, and it was the worst year in the stock since 2008. They won the World Series in 2008 in the heart of the financial crisis.
Mm-hmm.
The Philadelphia Athletics won the World Series in 1929, and we kind of remember. Well, we don't remember, but we know what happened in 1929. Yes. They won the World Series in 1910 and 1911, and there was the market panic of 1910 and 1911. So, I'm sorry to our neighbors to the east, but I think that's it. I don't think we can allow a team from Philadelphia to win anything ever again.
That's a playful one, and I mean, I was talking about that literally with the Super Bowl week, saying, now, believe me, as a Bengals fan, we don't like the Chiefs that much either. So I was very torn on and at the time I said, I could take a market crisis. I don't want the Chiefs to win, but looking back, maybe I take that back the way this has gone. But I mean, listen, we look at all these things. I mean, the S&P was up 20% 2 years in a row, was up over 70%. The first off the lows of October 22, the first quarter of a post-election year historically, where we just finished, is like the worst quarter, or one of the worst quarters out of an entire 4-year presidential cycle early after a 20% gain, you tend to have weakness. Oh, by the way, the last 20 years, first quarter is really weak. So we were open to the idea that we were probably going to have a 10 to 14% peak to trough correction at some point this year. No, we did not see President Trump going all in on tariffs like he did, like a lot of people. That's why we just saw a market crash, to be blunt. But, to see some volatility and see some scares and after the how do I say easy, but honest to goodness, the easy run we've had, although so many people missed it because they were scared the whole way up, it made sense. And then we were pretty optimistic this time 2 years ago in the Carson group, even 2.5 years ago. And we looked around, started this year, and all of a sudden, a lot of these long-term bears are acting like they were bullish the whole time. I will say that had my contrarian antenna up. But listen, last comment here. News trumps charts, and trumps is the key word there, right?
Yeah.
And we are in a news-heavy driven world, and the policies that's going in on the trade side of things. Again, be very, very clear. We didn't think it was going to come to this. A lot of people didn't think it was going to come to this, but that's why we just had, all the volatility we did. And at least at the time of recording this, a 17% peak to trough correction, down 11 or 12% on the year. And it wasn't that long ago. You and I done this 2 weeks ago. We're talking up on the year. I mean, this has happened really fast.
So we had you do a webinar with our clients during COVID.
Yeah.
And
that was fun too. You and I should hang out besides the time of a crisis.
Right. Yeah. But it's the reason why I wanted to have you on then, and the reason why I was adamant about having you on now is you do such a great job of explaining things that the average investor can understand. So
thanks.
In your best layman's terms, why is all this happening right now?
Yeah, well, how long do we have again?
I got all day.
Markets are all about what's priced in, what's not priced in. I mean, this time 3 months ago, everybody was talking about how great everything was going to be, animal spirits, market's going to go up forever. And I'm not saying we didn't drink from that same hymn, if you will. And we were pretty optimistic too. But again, then you have this realization of the tariffs, and to keep this fairly simple, when Liberation Day came last Wednesday and President Trump said 10%, the market rallied initially, 10% tariffs cross board. Market rallied initially because the market had priced in probably a little bit higher than 10%. It was optimistic. And then he held up that sheet with all the countries and all the different numbers, and everybody zoomed in on their phones and and we realized quickly, whoa, we're looking at an effective tariff rate of maybe 22 to 23%, the highest since 1910 or 1909, one or the other, a long time. Nobody was priced that in. This time a week ago, people were talking about, I bet the jobs number, and I didn't quite buy this one, but really smart people, I bet the jobs number is going to be a bigger deal this week than Liberation Day. And obviously looking back, no, not at all. Jobs number on Friday, no one even remembers. It was pretty good. Whatever. It's old news. So again, the market's about expectations, and those expectations were crushed because the worry, higher tariffs leads to a spike in inflation, and it will probably more of a short-term transitory, remember that word, transitory peak. But the Fed, the thing about this, we've talked a lot about this in our shop at Carson, the Fed's come in and kind of backstop things before. Jerome Powell had a chance last Friday to do that. He did not. He put cold water on the idea of any potential help from the Fed. That led to that 6% sell-off on Friday, along with China retaliations and all this stuff spiraling. So the truth, again, is who's going to blink first? Is it President Trump in Washington, or is it the Fed? We don't think it's going to be the Fed. Now, I'm not even saying blink first is the right maybe way to put it, because, again, this morning we saw a huge rally on talk of 90-day pause. And I'll tell you, listen, rumors happen for a reason. I think they threw that out there to see how the market would react. And they know
you and I both, buddy.
They come out and say 90-day pause, we're going to have a huge rally, right? So now a little back and forth. Last comment here. I'm optimistic, and again, maybe glass half full by a fault. Maybe we get some pretty significant deal with the EU or China. I know China just retaliated, but two things that China did on Friday, or didn't do, maybe I should say. They did not lower the yuan, okay? People thought they might lower the yuan if they're really looking to have more of a trade war. There's one more. April 10th, they said the 34% tariffs would go in, but you don't owe us money for 30 days. Implying, again, maybe a little olive branch at some deals. So we're optimistic U.S. and China, or maybe U.S. and EU, can find some common ground with the market as oversold as it is, as such negativity volatility out there that can cause some type of a low. Just this morning, the VIX spiked above 50. You want to keep things real simple here, Will. When the VIX spikes above 50, usually that's a time to close your eyes and buy for 6 months. And I know that doesn't feel good because it's spiking above 50 because bad things are happening. But we saw that, right? We've seen over the top negative sentiment. If we can get any good news, and hopefully it's on the trade front sooner than later, then we could have a pretty big bounce, because when you take that ball under the water for a while, let it go. Once it gets going, it gets going. We just need to get a little momentum to the upside.
Yep. Well, and perfectly titled your podcast, Facts versus Feelings.
Thank you.
You touched on that exactly. The VIX is the kind of the pain index, or the volatility index that we all follow to see, unfortunately, how uncertain things really are. And it's the hardest time to press that buy button. But in
Yes.
your facts versus feelings sort of a mantra, you would agree that this is not a time to let fear persuade you.
Yeah, exactly. I've had the honor to work with financial advisors. Let's call about 9 years now. Been watching the market every day. I wake up for 26 years now. And I've seen a lot of people get too optimistic at the peak. Honest to goodness, 4 months ago, Mag 7, right? Everybody loved Mag 7. It was the hottest thing out there. And that's not working so far this year. And the flip side, of course, is they want to sell at the absolute worst time because you can't take it anymore. October 2022, perfect example. COVID, obviously, good example. And we get it. These is tough. But I mean, obviously, that's why you've got a lot of great clients. And I've met some of them, right, that work with you, and you try to help them understand to be diversified, to rebalance, do these kind of geeky things that we talk about because it works. What do bonds do at the end of the day? To me, they help you sleep at night. Yeah, the stock market's down, let's call it 12% this year, approximately. Bonds are up 5%. Gold just had its best quarter since 86.
Yeah, how about that?
I mean, we've got some managed futures in our accounts that we do. We've done, Treasury's done really, really well in the accounts we run for our partners and their clients. But the reality is, listen, it's a real bad year. It's not fun for anybody. But unlike 22, when the stock market was killed, what did bonds do? Everybody remembers, bonds did poorly.
Also,
because, interest rates soared and bonds did horribly, and gold was I think flat-ish. Gold didn't give you much in 22. So it was a terrible time for investors. I'm not saying the last 2 months have been good for investors, but what I am saying is bonds and gold and some of these alternatives and your diversifiers, they've at least helped you sleep at night a little bit. I think if a client says, oh my God, I can't take it, sell out of everything. No, you don't want to do that. You can maybe go defensive. You can go low volatility. You can buy still some more defensive stocks if you really, really, really had to. But I was on radio this morning. I said, what do you think will bounce first? And it was a good question. I was like, the stuff that's beaten up the most. Okay, the time you and I were doing this, small caps were leading earlier. Technology was leading earlier. It's been volatile, but I think the most beaten up things are going to be the ones that bounce back the most right now. And, that's what we're watching for. That's what we're watching for.
Yeah. So, you and I both know, and it's the hardest message to convey, that it's time in the markets, not timing the markets. And that's it's hard, and it's not lost on us, on either of us. It's hard specifically for retirees who are living off of their portfolios, folks close to retirement who are hoping to be living off of their portfolios soon, folks getting ready to send their kids to college who need to use those portfolios to help pay for tuition. What's your message to them now as a chief market strategist who you and I both have been watching the market since, Greenspan's irrational exuberance, right? That was the first real news press conference I remember from a Fed chief. But what's the message to investors right now as they're staring at really more unprecedented market times?
Few thoughts here. The Greenspan speech was December 12th of 96. Again, he talked about irrational exuberance. The stock market went on to double. Okay. The NASDAQ went up like 300% from there. So maybe it was a little bubblicious, but that didn't, it kept going, right? The market can remain irrational longer than you can remain solvent. A popular one. One thing we've kind of kicked on, that's John Maynard Keynes said that one. So I'm not taking credit for that one. But the reality is some of the worst days of the year for the stock market happen very, very close to the best days. Okay. I've seen this throughout my career, and you're getting killed people want to sell, and then once all the sellers have exhausted themselves, boom, there you go. So again, like if someone really wanted to sell here, I mean, we're looking at like 3 or 4 of the worst days we've seen in a long, long time. We're going to have a bounce. We're going to have a bounce. Be patient. Don't just sell when it's all red. Maybe try to trim up and change some things on a little bit of a bounce if you really, really had to. But the key thing you just said, everybody's a little different, I'm aware. But I'm looking at it like if you have a decade, 15 years, 20 years, honest to goodness, you shouldn't be doing much at all. People ask
No.
me what I do, right? Well, last Friday, I put some money in my 401k. You know what I did? I actually put a little bit more in. Every 15th, every month, I put money in my kids' 529s. Last month, I put a little bit extra in, a couple $100 extra. You know what I'm going to do this month? I'm going to put a little bit even extra in this time because, again, I don't know what's going to happen. I mean, if this thing just crashes and burns, well, then I was wrong and we all are wrong. But what does history tell us? Since May 26th, 1896, the Dow started trading, 2 world wars, 200-year pandemics, all these really, really, really bad things have happened. A lot of good things have happened too. And if you have time, like you said, not timing the market, but time in the market, then you've got that on your side. One other playful one, but I like to use it. The stock market's the only place where things go on sale, but everyone runs out of the store screaming.
Right.
I mean, that sums it up. I mean, listen, I can't give like individual recommendations, but look at any of those Mag 7 names that probably everybody knows and loves and uses every single day. Like every single day you're using those probably 7 companies, honest to goodness. They're a lot lower than they were this time 6 months ago. So if you loved them 6 months ago, you probably don't want to touch them now. And that's not your fault. That's because caveman times. When things are bad, we huddle up. We're just trying to survive. And those are our brains. Our brains are great things. That's why great advisors like yourself help your clients understand, plans are useless, but planning is everything. General Eisenhower, honest to God, if 6 months ago you'd have said some of these Mag 7 names that everybody loves were cut in half or down 30, 40%, I'll bet your clients would say, oh my goodness, I'd love to buy some of those solid companies. And now here we are and people are frozen. And again, we get it. We get why. But just remember that these are these times you're going to make really make opportunity with your longer term investments, not to change your plan, not to make anything drastic. Just continue to follow the plan. And likely when we look up in 15 years, we're not going to, we're going to remember Liberation Day. Trust me on that. But we're going to say, that was actually mine. Right? Yeah, like the U.S. debt downgrade when the market dropped 20% in a couple days, 2011. Like December of 18 when the market dropped 20% really fast because the Fed and the market disagreed on what they should do. Of course, COVID, 34% in 5 weeks. Who could ever forget that? And now we look back on them, not fondly. I'm not saying we look on these things fondly. Even 87, before my time, but 87 is another one, right? You look back like, oh my God, that was horrible. But then you're like, wow, I'm really glad I didn't panic. I didn't sell everything. I didn't do this or that. I just maybe stuck with my process. The best investors I've ever met in the 26 years I've done this are just the regular people who every 2 weeks put money in their 401k and did not mess with it for 30 years. And I know that sounds easier said than done. I get it. But that's really important. I know that's the stuff you stress to your clients and why you do such a great job working with them.
So I'm going to ask you to put your macro hat on here for a second. And I know you're a market
here. How you like this? I've still got this. It's a you see this here? It's my St. Patrick's Day hat. I don't know. I always get dressed up. So there's my macro hat, my St. Patty's Day hat. We'll put that back there. There you go.
So and I know you're a market strategist, but you understand the macro side.
Oh yeah.
Without getting incredibly political, are these tariffs necessary? Is this something that is necessary that we go through, and is it going to work?
Wow, that's a good one. I mean, I'd say no, they're not necessary because we've done okay without tariffs for a very, very long time. Let's be clear. Right. But as someone who grew up in Springfield, Ohio, the Rust Belt, if you will, I saw my town what it was to what it became, and a lot of the manufacturing jobs and things did leave. And it is what it is. This is what President Trump ran on. This is what a lot of people voted for, was to do some of these things to bring back manufacturing. It's such a tough situation because we've all seen charts. Like this is the percent of people that work in manufacturing. It's just gone straight up to straight down. And we're trying to bring some of these things back. And you think about it with automation and AI. I mean, are we really going to be able to bring back a lot of these manufacturing jobs? I'm not sure, but clearly that's what we're trying to do here. Now I do think that, that we can we can even thrive with some of these things, but we need to take some of these tariffs back. I mean, that's the honest truth. We can't come out with all these. I mean, and again, read Trump's books, right? What's he
Right.
do? Art of the deal. You come up with a crazy thing in the beginning. People think you're nuts, and then you meet somewhere in the middle. Well, we've got the kind of the crazy part out here. Let's hope that we can meet somewhere closer to the middle. And it makes sense. I mean, listen, the bottom 50% of this country aren't doing that well. We
Right.
understand that. We feel that. And you know what? When the market was just crashing last week, I've got some family members like this that they didn't really care the stock market's crashing because in their eyes, we're doing things to try to help a lot of other people in the country. So it's very touchy. It's very sticky, very touchy subject. But I think if we get some of these tariffs back and we leave some of them on, I mean, let's put it this way. In 2018, when the first tariff war started with China, and that was just China, much smaller than now. I get all that stuff. There wasn't really any inflation. The economy did just fine. We had a 10% violent correction in February into March of 2018. And by September, we were back to making new highs. Now, I hate to say this time is different. Sir John Templeton, foremost dangerous words. This time is a little different because it's massive tariffs across the globe. One positive, and again, we're just, I hate to say grasping at straws here. One positive, everybody talks about 1930 and the Smoot-Hawley Act or Smoot-Hawley Act, where we had a lot of tariffs and it led to or extended the Great Depression, probably what I should say. Well, that was true. I mean, that did. But you know what happened back then? All these different countries were raising each other's tariffs. Right now, for whatever this is worth, it's like the U.S. versus everybody else. So everybody else are not going after each other yet. And I don't think that's going to happen. We'll see. I mean, stay tuned. Believe me, this stuff can change in a hurry. But I think, there is some some theory behind this. Had to know it was going to cause a lot of pain, and the hope is it causes a lot of pain. I mean, China's economy is not that strong. Okay, so if we really put the screws to China here, like it looks like we're trying to do, all this really comes down to us and China, to be honest. Everybody else is show, in my opinion. If China can concede to a degree, do something on the trade front. I mean, like they hiked 34% on the stuff that they buy from us. So they don't buy anything from us. Okay, I mean, we don't really buy that much. It's like it's kind of different than what it once was. I mean, they buy some stuff from us, but it's not the same as it was because all those tariffs were put on in 2018. So again, it's a unique situation. I think we need to get cooler heads to come in, but we can live with some tariffs. I don't think that's going to. I mean, listen, it's a incredible world we live in. It's more dynamic than it's ever been. The U.S. is more dynamic than it's ever been. We're going to adjust. Just tell companies what it is. I know you work with small business owners. A lot of them are probably your clients. Like they're confused what they're supposed to do right now. I've got an uncle who lives in a neighbor. He works. I'm not going to name the company, but big steel company. You've heard of the, trust me, you've heard the steel company. And he's like, yeah, we don't know what's going on. And my wife and I were looking at about a month ago, maybe get some work done in our kitchen, like remodel the kitchen, right? Well, the guy was like, I don't know what it's going to cost you. He's like, I have no idea what this is going to cost you because we get our wood from Canada. I mean, and this is back when you didn't really know what was going on. So there are a lot of uncertainty. Uncertainty is the word of the day, the word of the month, the word of the year. Yeah. Markets can go up on good news. They can go up on bad news. 5 years ago right now, some of the worst headlines we've ever seen. April of 2000, look it up. The Dow, I think, gained like 12 or 13%, something like that. One of the best months ever with horrible headlines on bad news because, it was less bad and a little more certainty on things. With all the uncertainty right now, we just need to get some more certainty, and maybe it's going to come on the trade. It's going to likely come on the trade front with the U.S. and China and or the EU, hopefully. And it'd be nice to deal with both of them, but we'll just see on that front. So I don't know if I answered your question. I did a little word diarrhea there, but it's a tough one because there's a lot of angles to this, obviously. But let's put a bow on it like this. Did the market like it? No. Market took a sell first, ask question later mentality. Cooler heads will prevail as they always have. But I'll tell you, clearly the market was not a fan of what happened on Liberation Day.
Right. I mean, I'm a small business owner. The uncertainty is real. It's not lost on us. And we do. We just want answers. Yeah. We don't care what the answers are in a lot of regard. And the market's the same way. The market generally doesn't care what the answers are. We know that the market generally doesn't care about a lot of things. They just want to know what the answers are. And then from there, the market will react. So as we're trying to predict the future, your best analyst view, where do we head from here?
Yeah. Well, if you don't have a recession, which is still our base case, I mean, I work with a very smart guy named Sonu Varghese. He's titled Global Macro Strategist. He's your
co-host on the Facts.
Yeah, co-host on Facts versus Feelings podcast. Yep, Sonu's awesome, and he's really good. He gets into the stuff way in the weeds, and he's very, very bright. He said over the next 6 to 9 months, he'd put about a 35% chance of a recession. That's higher. We came into this year saying like 10 to 15%. Okay, we didn't think, but now listen, we're adjusting to the information. So if we can still avoid a recession, recession, which is our base case, because we still think we're gonna get some good news on the trade front here, and then it's been rough. I mean, honest to goodness, the first quarter is like the worst quarter of the last 20 years on average, and it's not even that close. We've got a lot of negative prints in the first quarter for lots of different reasons, not because of trade wars. So that's one way there. So if you don't have a recession, you can have a bear market without a recession. This is where I'm going with this. You can down about 24, 25%. Take a wild guess where 22 ended. That bear market down 25% without a recession. With the recession, bear markets are ballpark 34, 35%, right? So we know these things, and we don't think we're going to have a recession. Now, we can have a bear market. By the time people are listening to this, we might be in a bear market. But, we're down 17, 18% or so, give or take. So that's not that far away from 25. Not saying it can't get worse than 25, but I think I'd be more optimistic here. I mean, if you were sitting around waiting to add some risk to your portfolios, well, this is a wonderful time. I mean, it's not saying it's the lows, but this is a wonderful time. So we kind of can assume that. The other thing that we can always kind of assume, or not even assume, wrong way to put it, is this is why you diversify. I mean, this is why you do it, because I had so many people, when I went on CNBC last year, second half of last year, we said, we're more neutral tech. I'm telling you, Will, people looked at me like we were just like I had three eyes for saying neutral tech, because everyone loved tech. Tech led in 23 and 24. We do like those quilts, those charts with all the different colors, all different sectors. We've never seen a group lead 3 years in a row. And I didn't mean it couldn't happen, but not surprisingly, literally the worst group this year is large cap tech. It was the best the last 2 years. Now, I'm not saying that's against large cap tech. I'm just saying this is why you kind of look at things from a whole big global point of view. Don't just chase the shiny object. And by that, I mean the best performing groups. Diversify, rebalance, do all those geeky things that you talk about and I talk about and our team talks about. People think, we're just like stock jockeys, or I am, and just talking about this, talking about that. And yes, to a degree, that's what I do sometimes in the media in a 90-second hit. But we manage over $4 billion on our team. We've added some treasuries, right? We've added some international exposure before all this stuff started. We were very overweight equities. We were 90% equities in our unconstrained models in 23 and a good chunk of 24. As this cycle aged, we started moving it back. Trust me, I wish we would move back a whole bunch more if I knew what I know now. But it is what it is. But I'm still pretty proud of the way that we managing money's tough. I mean, it's easy to go on TV and pontificate and say one thing, come back the next time, say another. Big deal, no consequences. When you manage people's livelihoods, you manage people's retirements, that's a big onus on people, not something we take lightly. We're honored to do it.
Agreed.
And I'm still proud of how we've done. I mean, believe me, we didn't see this coming. So I'll be very clear there, but we're still optimistic that when we look up, we're hopefully going to be back to positive for the year. I mean, we technically still have about a 10 to 12% target on the year. I don't know if we're going to get there right now, but we are in the money we run. We're still overweight equities. Okay. This happened so fast. It's where we are. We're still overweight equities, but I think I feel pretty comfortable saying I'm still overweight equities. We're not so sure we're going to have a recession. I know everybody's telling us we are, but we'll see. First quarter earnings are coming up soon. We'll get much more clarity then. Now, one final comment on this, as of like the first quarter, right? For the U.S. was down, India was down. Everybody else was up. Now, trust me, over the last week, everybody's down. I get that. But is the big question, is the U.S. going to play catch up with the rest of the world, or is the rest of the world going to be pulled down to the U.S.? I mean, we're optimistic the U.S. is still going to be a decent cog of growth going forward. I think the U.S. is going to play catch up to the upside versus a lot of other parts of the globe when all is said and done in 2025.
Yep, we agree, and I mean, there's no better place to do business. I mean, I may sound like a bit of a homer there, but no, and the message we try to get, and I know that as an asset manager, it's easy to get stuck in these quarterly cycles. It's very important to look beyond that and not. You mentioned the shiny object. You have to be careful when you go through things like this, and it's very easy to look for a product that's going to solve all of your anxiety right now. And I love the Eisenhower quote, like you said, plans are worthless. Planning is everything.
Plans are useless, but planning is everything.
And it's the best thing to do right now is to revisit your plan.
Yeah.
That's the best thing to do. Not shop for a product to make your belly feel better, but to revisit your plan. That's the message we send right now. And hopefully that's the message that's received. One more final prognostication before we wrap up here. How are the Bengals looking this season? Heading into the draft.
I figured this was coming. So I'm trying to.
Just so you know, the first time I met Ryan, I walked into his office with a terrible towel in my hand in Charlotte and handed him a terrible towel.
That hurt. That hurt. That hurt. I think my hands burned. I think they still burn. I still got a scar from touching that thing. No, I'm teasing. But listen, much like markets, right? The Bengals are top heavy. I mean, here's the truth. You can survive if you're all overweight large cap tech in 23, 24. How's it treating you in 25? Not good. They're spending all their money on their quarterback and 2 receivers. And it's tough because they've got a really good quarterback and 2 of the best receivers. When all 3 of them play, they usually win. Here's the catch. One of the, I feel like they're always hurt, especially T. Higgins. T. Higgins, he just pulls a hammy like walking up the steps. I mean, love the guy, but my goodness gracious, like stretch a little more or something. But so the reality is, they're going to score a lot of points, this and that. But if you can't protect the quarterback, which has been their troublesome spot, and if you can't stop anybody, they have a terrible defense. I mean, the Bengals, I think, lost 4 or 5 games scoring 30 points last year. In Tom Brady's entire career, which I think was 18, 19 years, I think he lost like 2 games scoring 30 points. Bengals did double that just last year. So they can score. Burrow is amazing. Chase is incredible. And T. Higgins, when he's healthy, is right up there with anybody. Just like a diversified portfolio, though, it works until it doesn't. And last year it didn't work. So I'm hoping for a tech-heavy bull market with my Bengals next year, scoring a bunch of points.
Too,
but
and
now they did get last, or no, I guess the Browns were last in the division, but they didn't have a very good division. So in theory, they should play some of the weaker teams, but sometimes that doesn't always play out that way. But, listen, I am an Ohio State fan too, so that's why God gave us Ohio State Buckeyes. So they're pretty good at football. So I could put up with the Bengals being ridiculous and aggravating. And rumor is they might move. I think that's just some fake news, I hope. But they're talking about that. I think they're just playing hardball with the county, trying to get a lot more money to their to the stadium, which is 25 years old. They need to fix the stadium up. I told my boys, I remember going to the first game at that new Paul Brown Stadium, was called back then. But just need to fix it up. But bottom line, who knows? Maybe win 10 games, sneak into the playoffs with a guy like Burrow. Just keep him upright. I like our chances. So we'll see. We'll see. But defense ain't going to be any good again. That's the bottom line, man. How about the Steelers? What do you think?
Well, like I said, the market sometimes just wants to know. And I think that's how Pittsburgh is right now when it comes to a quarterback. We just want to know who the quarterback is, because Mason Rudolph came back, and everybody else though has fled. So we're sitting here waiting and anticipating, just like what's going to happen with tariffs. What's going to happen with the Steelers quarterback? We would love to know.
I just looked. S&P was down 23 basis points, so virtually flat from where futures opened on Sunday night to finish flat. I think when futures opened down 6%, any of us would have taken down 23 basis points. So we'll take it. But go ahead.
Closing out one of the most wild days that I can remember on Wall Street. I couldn't think of anybody else that I would have wanted to talk to today and have on our show. Thank you for joining us. If you're active on X, follow Ryan. He delivers such great insight and it's such good information that the average investor can look at this and calm themselves. It's a place where I go to because, listen, like he said, we're managing folks' money, and that's not lost on us. We do take it personal, and we do look for calming things. And Ryan's Twitter feed is always pretty good. Check out the Facts versus Feelings podcast. It's another great place to get great market information and kind of rationalize when things are going wild like this. I look forward to having you back on. And again, maybe one of these times it's not going to be in a wild market scenario or in the middle of a crisis, and we can talk in the middle of a bull market and maybe a Steelers-Bengals AFC Championship game.
Maybe we should do this before the Bengals play the Steelers next time. But I will say this, Will. Thank you for having me back. It was an honor. It was a lot of fun. I know the half hour goes fast, so I hope all the listeners enjoyed this. But just thank you for I love the way you're kind of forward-looking and you're pushing, doing things like this. And I've got to meet you. I've got to meet your clients over the years. The things you're doing to help them and help them grow is second to none. And it's a big honor to be back. And I'm always cheering for you and your son and your family. And I know all the stuff you've got going on in your personal life too. So definitely just an honor to know you and call you a friend, and I'm glad this all worked out. Now I'll come back next time, but again, let's pick a calmer day. All right?
Yeah, sounds good, man. Thanks for joining us.
Thank you.
Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.